Hey guys, today I wanted to talk about Coreweave and their profitability and if they'll be able to handle their financial obligations, debt. And I'm interested in that because when I saw Coreweave's stock price diving over the past month, I kind of realized, oof, they're in a really nasty spot. I mean, they're levered with debt to the most you might ever see with a company. And in my eyes, CoreWeave's being used as a tool to hedge other companies' risks and to juice other companies' profits. I mean, it's taking on the risk and the cost of building out these data centers that bigger tech companies can rent out while they build their own data centers, which may very well wind up competing with CoreWeave. So I wanted to start this off by looking at the company's balance sheet because in my eyes there's a big disconnect between what the bond market debt guys are saying and what the equity market is reflecting. Right, bond markets are saying, "Hey, this is a little risky. This is speculative stuff. This is definitely not investment grade." But then the equity market is showing 100% gain, right, this year. So I wanted to look up because at their balance sheet and start here because they're levered to the max. I mean, they have tremendous amounts of debt. If you look at their long-term debt here, it's about $10 billion. They have capital leases of 4 billion. They have a current portion of about 3.7 billion. And then also not even this isn't what we're talking about, but I mean they have a lot of deferred revenue, right? So they're collecting revenue and they have a direct obligation that they haven't fulfilled yet. When you see some of these slowdowns coming in development, even if it's from a third party, you start to get worried with revenue collection, with debt mounting up, with clients leaving. But anyway, getting back to the core of it, you can see their debt is something around 19 billion here. And if you just take a look at their equity line, they only have 4 billion in equity. So I mean, they're almost 5 times levered on debt than they have to equity, which is very scary. There's something very, very, very small could shake up this company. And when you look into it more, much of the debt comes from GPU secured loans, often in the form of SPVs, where the collateral is these NVIDIA chips. But, one problem I see here is that these NVIDIA chips depreciate quickly, very quickly as new generations come out. An example being the H100 to the Blackwell to the Rubin. And I mean, when things don't have use cases anymore, it's going to depreciate faster, which is all your collateral's now gone for the loan. And there's just a huge interest crush, right? I mean, we're talking as of right now, $1.2 billion in annual interest. I mean, it's eating up most of the company's profits. The Q3 operating margin was only 4%. Even with growth, net losses persist. And I mean, there's covenant and default risk here too, in the sense that the loans have tight triggers like must bill 85% of forecasted revenue, rates rise if customers downgrade, and they already had a technical default in 2024 and it was waived. There's a refinancing risk here, right? In the sense that they have so much debt in a higher rate environment, or if AI hype cools, rolling over $14 billion to refinance becomes expensive or just outright impossible. And we touched on this already a little, but there's definitely some execution and delay risk with recent Q3 guidance cut with delays at a third party data center build out shows even small slips push revenue way out and trigger lease payments without income. Now you're going to be worried our customers going to switch. And then going back to the collateral depreciation, as NVIDIA releases better and faster chips, older GPUs lose value. Lenders could demand more collateral or accelerate the repayment terms. The customer concentration churn is another risk here because there's such a heavy reliance on Microsoft and OpenAI. Once they finish their own data centers, they could just walk away from this company. They won't need them anymore. And what I mean by the debt market being a little skeptical here of CoreWeave is that Coreweave was assigned a B plus issuer credit rating. At first glance, you might think, oh, that's pretty good, B plus. It tacks down here S&P Global's, ratings tiered in order. A B rating, as you can see about in the middle of this list, is speculative grade. Okay, speculative grade company is what's another word people use for that? Junk bonds. Companies that have high yields that they don't think are going to pay them back. Many regulated investors, right? We're talking the pension funds, the mutual funds, banks. They're only allowed to buy investment grade BB plus. So I mean, they're still down. They're still down two tiers. They have to cross BB, and then they have to get into BBB, which you can be B plus or just get BBB. But I mean, they still have, from the debt markets perspective, a long way to go before they're investment grade stock or bonds in this case. And here's a picture of the stock's 1 month graph. You can see it's been beaten up pretty good here. They lowered full year 2025 revenue guidance to about 5 billion from about 5.3 billion due to those delays in that third party data center development and compute supply constraints. In general, people are really afraid that customers will start canceling contracts with these delays. There are a lot of covenants and triggers in these debt agreements that we've kind of started to touch on, and we'll get more on that later. But the company's still not profitable and does not intend to be. By my projections, they're not going to be free cash flow positive until 2028, and then they're going to be paying down debt for a while. The CEO cited that 2026, this upcoming year, is going to be their biggest cash burn yet, which just really contributed to investors getting worried, and hence the 40% drop in 1 month. Here I have a picture of the company's income statement to just kind of illustrate the problems we've been talking about, right? They have massive debt, as we could see from the prior slides, but when you take a look at the income statement, how are they going to service this debt, right? Just looking at the past 4 years of operating history, the company continues to lose massive amounts of money with the LTM almost at a full $1 billion loss. And I mean, the company still has a lot of capital expenditures it has to take to build up, all this capacity for the hyperscalers to use. So, now we're going to take a look in my next slide here, the next coming slides, of how exactly they plan to pay back this debt and see, is Coreweave even solvent? So obviously we know from looking at the debt to equity, looking at the income that covers those and services those debt payments. I mean, this company is levered. They are debt up to the ceiling. Okay. And just my 2 cents from working this analysis is, I mean, they will not be able to survive any sort of major sustained shock to the debt or capital markets with their current financial position. I mean, they are betting right now that everything is going perfect and they're going to execute perfectly. And you're already starting to see the delays. I'm telling you, these hyperscalers are eventually going to move away and build out their own. So anyway, let's hop into the analysis here. So essentially what I have is 2025 to 2036, and a lot of this debt is coming due in 2028, but we're really not going to see profitable free cash flows until 2028. So why I'm pointing that out, right, is because that means from 2025, 2026, and 2027, they're going to have to keep pulling on debt to build out these data centers, right? So if you take a look, I have debt lined up first here at 19 billion, and blended rate of, I calculated, just about 11% on their debt. Now, the incremental capex they're going to need is going to be, the capital expenditures needed to continue to build out these data centers that they can't pay for themselves. And that's taken from estimates from management, right? They said 2026, 2027 was going to be really big cash burns. You can see the incremental cash flow needed, $40 billion in both years. And then next I have their interest payment, right? So just to show you how much they're getting clobbered, I mean, they're on track for 2025 to be paying $2 billion in interest here, and for the foreseeable future until 2035. And next is their free cash flow line, which I did from my DCF. So if you look at their free cash flow negative until 2028. But once 2028 comes in and they start to realize these profits, I mean, it goes up quick. You can see they go from free cash flow of 4 billion in 28 to about 145 billion in 2035 if everything pans out, right? So it looks extremely attractive. The only thing I don't like is, right, if they get to 2036 and there's no, recession, there's no tightening in the capital markets, the company performs, it stops having these delays and executes, and the hyperscalers don't move out. I mean, this thing could easily 10x. I mean, but what I'm worried about is the debt, and I just can't get past it. I mean, these next until 2028, it's going to be brutal. I mean, they're going to need to be pulling on, I've calculated here, just almost $150 billion of debt. Okay. And if you look at their free cash flow, they're not generating any until 2028. So I have it going through, right about 2028 is their last pull, because they'll have started paying down debt and be free cash flow positive, and then by 2029 there's no more pulls through 2035, and they're just using, and this isn't going to be the case, right? They're not going to use every single dollar of free cash flow to pay down debt, but even if they did in this scenario, then by some point in 2036 they would have paid down all of their debt if they put 100% of free cash flows, and execution went perfectly and there were no problems in the markets. I mean, that's really scary, right? Because you're bidding on a lot of risks. A company that's down 40% on the month, but is still up 100% on the year. And we're talking about a company that won't be able to relieve themselves of debt until 2036. I mean, that's 10 years from now. It's 11 years from now. The opportunity cost in finding another stock with less risk and more upside and just away from this debt. I mean, if you want to stay in the data centers, take Nebius. I mean, they at least have their balance sheet under wraps. I mean, this is disastrous. This is by no means an easy path forward for this company. All right, so that's it. That's all I had for you guys. To me personally, Coreweave is just way too much levered on debt, while a lot of risk factors with, a lot of things that can trigger certain things in the debt. There's variable rate interest. We're betting on the hyperscalers, and they're going to build out their own data centers. The company's not profitable. It's mounting on debt. For me, just too risky.